All right, guys, how's everything doing? This is Eli, and we got a special guest on the Urban Lifestyle channel today. We have Yankee stacking.
Thank you, Eli. Yeah, I'm yanking it. How you doing, man?
I'm good, and yourself?
Great, man. It's a tremendous honor to be on this with you.
It's an honor to have you on here, bro. Appreciate it.
Thanks.
All right. Hold up. Yankee stacking, all due respect, I love your intro, but this is still the Urban Lifestyle channel. So let's go. So tell us a little bit about yourself.
Sure. Well, I think I already just told you this before we went live. I'm 52 years old. I'm a dad of 3 kids. They're getting older. Okay. That's what happens, man. They just keep growing up. But I love being on YouTube. I've been on YouTube for about 5 months and love stacking.
Okay. Let's just get right into it. Right. What started you? What sparked your interest in stacking?
Well, my dad. I'll go back 40 years. My dad was a great guy who knew what money was, right? So he and I would go to the local coin shop back then, and I was getting silver for $9 an ounce at that point. He loved silver dimes. He loved the denomination. He loved the recognizability of it. So we'd do Rosies and Mercs, and just had a blast doing that. I was really blessed to have a dad that took time to do that. Taught me good fiscal sense. My dad worked very hard, and we lived as a family below our means. So that meant avoiding debt and saving. We don't really do a whole lot of it right now. So you're right. So this is back in the 80s, and you could make 6 to 8% interest in the bank. You could make 10 to 12 with the CD. I mean, back then it was about low risk investing. That really honored the saver, not the spender. So that's how I grew up. My dad was middle class. He was an elementary school principal, single income family, so we had to live within our means. We saved to go on a vacation. We didn't have money, didn't go on a vacation. So that's how my life was, and stacking was pretty much getting silver dimes. And so I have a lot of silver dimes. Then, when I became an adult, I kind of drifted away a little bit from precious metals. Really, if you fast forward to the late 80s and 90s, I was all about stocks, bonds, mutual funds. I did my research. I invested as wisely as I could. And Eli, I rode out 2 significant bear markets during that time frame, right? So there was a short one in 87, and then there was the bigger one in 2001 after 9/11, the dot-com bust. So both those times, I used them as buying opportunities. I dollar cost average. I just plowed my money into it. I was working, a young guy, newly married. I was just like, I'm going to max out my 401k, do everything I can. So I was all in on the stock market, bonds, you name it. And then the recession hit, 2008. When I saw that happen, I sold out as much as I could in my stocks. I moved into bonds, and then it hit the bond market hard, and I liquidated. I completely got out. We got out before the worst of it, actually. So I didn't lose a whole lot. But it changed for me at that point. That was a seminal point. And I said, this is different this time. Frankly, Eli, I think the Federal Reserve disemboweled our economy when they did QE1 and 2 and 3 and ZERB and Operation Twist and all that crap. They just went all in. And at that point, I realized the Fed is going to do anything they can, whatever it takes, to keep the Ponzi scheme that we have going, even if it means messing our dollar and in rampant inflation and all that. So I said, you know what, this is different. I'm not going in. So I shifted dramatically away from the market and got into private mortgage lending. I was blessed to be able to get out of a job. I was transitioning from one job to the other right when this was happening. And instead of rolling my 401k over into my new job, I moved it to a self-directed IRA, all of it. And with that, I was able to do other types of investments with different vehicles. So I got into, like I said, private mortgage lending, which gave me the cash flow that I needed. It was a lot safer than the markets. I didn't, I'm not going to make 20, 30%, but at the same time, it was a very, straightforward monthly annual percentage yield. So I was very happy with that. That's sort of my investment vehicle. And then I got into precious metals. And precious metals to me is, and it's to a lot of people I know, preservation of wealth. It is, frankly, insurance, not so much a yielding type of investment for me. I bought my, what I affectionately call my Yankee cannon at that time in 2009. Yeah, that was an interesting conversation with the missus. I said, this is the time to do this. I got in. I think it was right at $1,000 an ounce. So that's when I bought the roll. So yeah, that was a big investment. So I went in first with gold, and then ever since then, it was like, what do I need to do with silver? So I've been stacking for several years, but really the last 2 years in earnest. So yeah, it's been and you know what? Because the Fed has been keeping interest rates so low for 8 and 9 years, this is the best time we've had right now to stack silver. I might have had $9 an ounce when I was a kid, but $14, $15, $16 an ounce, that's phenomenal. So yep. So that's where I came to, that's where I am right now.
Okay. Yeah, man, you mentioned something as well, like as a kid, like you said, 40 years ago, your dad planted a seed in you.
Sure did.
And it just reflects on me. I'm like, hey, this is what I'm planting for my son, because this wasn't planted for me.
Yep.
Only thing that was planned was, hey, you got to save as much money as you can,
right.
And then saving money, and it's like, all right, let's say I saved money from the time I was born. I lost practically almost more than half the amount that I saved. So
right.
So just installing that into my daughter's time frame, into my son's time frame, and it's just just imagine where they're going to be.
Those kids don't know how blessed they are to have that. I do the same thing with my kids. We've taught our family, my kids, proper use of money, how to budget, how to avoid debt, unnecessary debt, consumer debt, revolving debt, all that. Live a debt-free life. That's number one. Paid off our mortgage, made sure that we did it the best way we can. That meant maybe we didn't have all the toys our neighbors had. Maybe it didn't mean all the trips they have. And maybe, you know what I'm saying? You don't get everything when you do that. You don't live a lifestyle that unfortunately our society is too focused on. And that is, I deserve the fun. I deserve everything, and I want it, and I want it now. And we're paying the price. We're paying the price right now with that debt mindset. The thing that's just popping into my head right now is the government shutdown. And however you feel about that, the thing that just jumps out at me more than anything else is that people are struggling to handle one missed paycheck. Now, no, I don't want to come across wrong, Eli. I'm not trying to be harsh. I'm not trying to be insensitive here, okay? But come on. I mean, it should really, everybody that listens to this should realize that that's not the right thing. You should not have to run to eBay or your pawn shop after one missed paycheck. They're going to get paid eventually, and I don't think this is going to take much longer for this for a deal to be struck. They can't go much longer. A few weeks and that's it. But I mean, did you know that half of our American brothers and sisters can't handle an unexpected $400 expense?
That's true.
They can't.
That's true.
It's sad. I grew up in an era that when you saved for a rainy day, it meant something. When you lived below your means, you had money that you would be able to weather a storm. We cannot weather a storm right now. So that should be in the back of people's minds. Like, why are we struggling so hard? when this happens. Now, again, I want people to get paid. Don't get me wrong. I hope this thing ends soon. But wow, that's it's telling.
Nah, that makes so much sense. Like you just put it in, like you know, I always thought about it that way, but you just like enlightened me to it. Like one missed paycheck, and especially like you said, there one, how can I say it? There's a lot of people, they're one financial crisis away from being broke.
Right. And again, I want to caveat this. Bad things happen to people. Divorce happens, catastrophes happen in your home, illnesses, cancer, you name it. I get that, right? I mean, but I'm not talking about that. I'm talking about people living hand to mouth, paycheck to paycheck, because they're so levered up, they're so debt ridden with their revolving credit. That's a big problem. I posted a graph. I'm a very visual person. I posted a graph on my Instagram account about 2 weeks ago. And it was so telling. It showed what revolving and non-revolving debt was growing since the Great Recession 10 years ago. And it wasn't just going up. It was going up at a faster rate. So we are taking on debt, not just more and more, but faster and faster. So we need to be very concerned about that. It's just, so anyways, let me back up. So that was my background, but right now where I think I'm at is, I think we're witnessing something, Eli, you and I, that we've never witnessed before. A confluence of bubbles in our economy that has been blown up to gargantuan proportions, huge, unlike you've ever seen. One of my early videos that probably I would be embarrassed to look at on my YouTube channel was about stacking the Yankee way, right? And it talked about my journey that I just summarized for you. But the episode 2 talked about the bubbles, and I talked about 10 bubbles that we are seeing ready to pop. And they're huge. They're far bigger than they were in 2008, when the Fed, instead of letting it correct, blew air into it, sacrificed everything. And now we have them even bigger. We've got, I'll list a couple of them. We got a pension bubble. States are incredibly underfunded. Student loan bubble. Auto loan bubble. The personal debt bubble that I just mentioned. Corporate bond credit bubble. Companies are taking on more and more riskier investments all the time. The derivatives bubble. These things, I could go on and on, but what I'm saying is that, like, you and I are witnessing something huge. Our government is unable to handle the explosive debt. We can never repay it back. What the Fed did was devalue our money so much that it is so dirt cheap to borrow. Look, let me give you an analogy. Imagine you go to a casino, right? And you bring $2,000 or $5,000, $2,000, $5,000, whatever. You go to the craps table and you blow it all, right? But the casino comes and says, you know what? We like your style. We're going to give you $2.5 million. You got to stay in the casino, play it, but it's house money. What would you think? Well, it's free money. What's going to go wrong? Let it ride, right? So, and I'm not a gambler. I don't go to casinos, but I'm just saying that, you know, that's kind of what they did. And I don't care how many drinks you're comped, or your room, or how many women are holding on to you. You may look like you're a high roller, but Eli, you're still $2.5 million in debt, right? That's where we are in our economy. We got cheap, free money. We've had it for the longest time, for 7, 8 years. Companies have taken on that debt. People have taken on that debt. Shoot, the government has taken on that debt. Everybody's taking on this debt because it's free money. Crazy not to. And inflation has been, absorbed in the markets as it's gone all overseas. We think everything is so awesome, just like the Lego movie. Everything is awesome, right? But it's not. We are so far in debt and so unable to raise interest rates. Look what the Fed's been trying to do. Easy weensy little quarter point rises. Now remember, I remember interest rates 6, 7, 8, 9. Those are nominal rates. So those are rates that were normal for people who saved. You can go to the bank. That's how money works, right? You get a return on investment. Well, not now. We've been at zero forever, and then they've been slowly trying to raise it. And what are the markets doing?
Tanking.
They are, man. They're hurting. That's the biggest indicator to me that we've got a big problem. If the Fed can't get, now the nominal rate is what, 2, 2.25?
Yeah, around there.
Inflation's that. So in real terms, we're getting zero, right? So they can't even get past zero in real terms without a meltdown. So one of there was a video I posted. What was it? Maybe 2 weeks ago? No, not even. Beginning of the year. It was my predictions video, and I just do it for fun. I'm not a financial advisor, even though I love to play macroeconomic games. But I just wanted to have fun and make some predictions. One of them was that I did not believe, and still do not believe, that the Fed is going to raise interest rates at all in 2019. At all. They backed off of 4, dropped it to 2, and then right when I was ready to drop that video and I was driving into work, I was listening to the radio and they said, "Oh, Jerome Powell's going to be talking with Ben Bernanke and Janet Yellen on a roundtable," and I'm like, "Oh crap! I got to drop that video." So I went to work and I went right on YouTube and went post, because I thought he was going to go all dovish. And back off the rate hikes. That's what he did. He's already starting to roll back. He's, they're getting their ducks in a row. I think in the next few weeks, you're going to hear more and more like, well, we can't raise interest rates. We just can't do that. They claim they're data driven, but they're really market driven. They're watching the markets. They're not going to do it. That's my opinion. And once they don't do it in March, I don't think you're going to see it in the summer, because that leads me to the second prediction I made. I believe we're going to be in recession by the end of the summer. I do.
Okay. I thought we were. I thought you gave it more of a time than I did. I thought we was going to be in it like after next week. I thought we was going to be in a recession.
I don't think.
Why do you think that, though?
Yeah. Well, one of the things is that I think it was Alan Keyes that once said that the markets can stay irrational longer than you can stay solvent. And that is so true. Sometimes you think, oh, something bad's going to happen, and it just keeps going and going and going, right? They kick the can down the road, or in this case, they've kicked it up Mount freaking Everest. But it just seems to go on forever, right? But I think a couple things are going to happen. One is they're going to get this deal done with the budget deficit. With the budget, they're going to come to some agreement. They can't keep going. I mean, 1-2 more weeks, it's going to come to the point in which they're going to get together. They'll strike a deal. Then, of course, they'll both claim victory and both sides of the aisle, right? But that's one thing. The market's going to love that. So I think the market's going to jump up. I think precious metals will dip. And then the second thing will hit. In February, you're going to see the different area feds. So they're basically going to come out and say, we're not going to be, we're going to be more accommodative. We're not going to raise rates. Markets are going to love that too. That's when I think my third prediction could come true. This is just for fun, Eli. Okay.
All right, guys, that was a phenomenal interview. Part 2 should be up very soon, today, matter of fact. And right now, as we speak, I am editing the video. All right. Matter of fact, let me make sure I'm checking. Let me check on myself to make sure I'm editing the video correctly. Hey, you. Are you properly editing the video?
Talking to me?
Yes, I'm talking about you. Yes, you.
Make sure it's good, okay?
Okay, I got you.
All right.
Guys, thank you so much for watching and have a wonderful day.